Welcome to This Explainer. Today, we are unpacking an absolutely fascinating shift in how we interact with the physical world around us. We're going to explore how a five-pillar tokenization framework is fundamentally re-architecting how we own, trade, and actually earn from massive physical asset classes. Basically, we're moving from a world of paper-based, highly illiquid wealth straight into a totally new era where physical assets actually become machine-readable. It's a real game changer. Here is a quick roadmap for our explainer today. 1. The real estate trap. 2. Enter the R token. 3. Navigating global legal frameworks. 4. Tokenizing physical infrastructure. And finally, 5. The untokenized final frontier. All right, to truly understand the sheer scale of what we're talking about here, we have to start with this number. According to Savills World Research back in 2023, global real estate is valued at over $326 trillion. It is by a massive margin the world's largest asset class. But here's the crazy paradox, right? It is also one of the most illiquid, operationally complex, and access-restricted asset classes on the planet. It's literally a mountain of wealth that is incredibly difficult to actually move around. Okay, let's dive into this contrast because it really highlights the problem. Say a hospital pension fund wants to buy or sell U.S. Treasury bonds. They can execute that trade in seconds. Boom, done. But what if they want to acquire an equivalent stake in a commercial office portfolio? Well, that requires months of legal work, millions of dollars in minimum commitments, and just accepting that their capital will be completely locked up for years. The operational friction is just massive. Which brings us to Section 1, the real estate trap, virtues and ceilings of the REIT. So what's the fix? Well, this brings us to the REIT token. Now, the absolutely crucial thing to grasp here is that a REIT token doesn't change the underlying physical asset at all. The building is still a building, and it still generates real, tangible cash flows from rent. What changes completely is your relationship as an investor with that asset. Tokenization fundamentally re-architects how that property is packaged, how it's distributed out to the world, how it's governed, and most importantly, how you access your liquidity. Let's look at the micro-mechanics of how this actually plays out, because honestly, this is where the magic happens. Instead of waiting on a property manager to cut a check to a fund administrator who then wires it to a bank, a tenant's rent payment goes directly into a smart contract-controlled wallet. That smart contract instantly calculates everyone's exact cut and distributes it automatically to the investors via Layer 2 blockchain networks. So if you hold exactly 1,000 out of 1 million tokens, you get exactly 0.1% of every single rent dollar. It happens in seconds with pure mathematical certainty, completely removing any need to trust a fund manager's clunky quarterly spreadsheet. That leads us right into Section 2. Enter the RE token, the vanguard of real estate tokenization. Let's look at who is actually doing this today. First up is Lofty. The absolute game changer with Lofty is the distribution frequency. They allow investors from all over the globe to buy into U.S. properties for as little as $50 using Algorand-based tokens. But the part that completely disrupts the standard real estate model, the rental income is distributed daily. Not quarterly, not annually, every single day. This fundamentally transforms your capital efficiency. Idle cash in a traditional bank earns basically nothing overnight, right? But capital in Lofty is compounding from day one. Next, we have Realty, which focuses heavily on Detroit area properties using Ethereum and Gnosis chain tokens. Realty's massive contribution to this space is entirely on the legal front. They basically pioneered the de facto standard for U.S. tokenization by placing each individual property into a separate Delaware LLC. By doing this, they explicitly tied the digital token ownership directly to real-world LLC membership interests. They utilized Delaware's highly flexible statutes to make tokenized real estate legally enforceable without needing a single new law passed. Pretty brilliant. Then there's Proppy. And Proppy is attacking a totally different friction point, the transaction itself. They essentially wrap the property holding LLC right into an NFT. Back in 2022, they actually completed the very first U.S. NFT-based real estate sale down in Florida. By recording all the deeds, titles, and agreements directly on-chain, they take a conventional, agonizing closing process that usually drags on for 30 to 60 days, and they collapse it into a matter of minutes. Which takes us to Section 3, Navigating Global Legal Frameworks, a 2SPV world. And this brilliantly illustrates just how differently jurisdictions around the world are tackling this. You have Delaware's flexible LLCs, and then Wyoming taking it a step further with DAO LLC legislation that legally recognizes smart contract governance. Over in Europe, it's highly complex. You're dealing with MiCA regulations layered on top of all these varied member state property laws. Meanwhile, Singapore is running Project Guardian, testing out English common law SPVs. Because of this massive global patchwork, a really clever consensus is emerging: the two SPV structure. Basically, you have one special purpose vehicle holding the local physical property, and that feeds its revenue up to a second token issuing SPV located in a highly favorable jurisdiction, like Delaware or Singapore. All right, shifting gears here for Section 4, tokenizing physical infrastructure, the DePIN revolution. So unlike real estate, which is an existing physical asset that gets wrapped in a digital token, decentralized physical infrastructure networks, or DePIN for short, are tokenized from birth. These networks crowdsource massive capital-intensive infrastructure. Think about it. Instead of a giant telecom company taking on billions in debt to build out a network, platforms like Helium incentivize independent, everyday operators to buy hardware hotspots to provide wireless coverage. The operators earn HNT tokens using a burn and mint equilibrium, which is just a fancy way of saying tokens are minted based on genuine, verified network usage by real clients. Render, Akash, and IO.net are doing the exact same thing for idle GPU compute power, which is absolutely critical for the AI boom right now, while Filecoin is handling decentralized data storage. The growth in this space has been nothing short of staggering. Based on industry tracking, the DePIN market capitalization jumped from roughly $5.2 billion in September 2024 to an incredible $19 billion just 1 year later in September 2025. And Grayscale Research estimates that hardware operators in mature networks can see annualized returns of 15 to 25%. And again, that's dependent on actual verifiable network usage. Now, this is vital to understand. This is not just speculative crypto value. As tracked by Masari, these networks generated $72 million in real, mathematically verifiable on-chain revenue in 2025. And driven heavily by this massive explosion in AI compute demand, estimates for January 2026 alone are hitting roughly $150 million. People are paying real, hard money to use this crowdsourced infrastructure. And we're seeing this exact same architecture now being applied to renewable energy, which is a massive $1.9 trillion global investment market. Tokenizing a solar farm perfectly mirrors the real estate model we discussed earlier. Instead of rent rolls, an on-chain oracle is fed by metered energy output data, and that automatically triggers proportional revenue distribution to the token holders. It's seamless. In fact, McKinsey estimates that this blockchain-based automation could actually improve annual returns on infrastructure assets by 2 to 5% simply by stripping out all that bloated administrative overhead. Section 5. The untokenized final frontier, traditional infrastructure. So what about traditional legacy public-private partnership assets? We're talking toll roads, major airports, water treatment facilities. Well, as of right now, this sector remains almost entirely untokenized. And the reason why is a fascinating structural irony. See, the technical architecture we've talked about today, the SPVs, the oracles, the smart contracts, it would work perfectly for a toll road. The oracle would literally just read the toll collection system. But traditional infrastructure concessions involve these incredibly complex government counterparties and decades-long contracts. More importantly, the institutional investors funding them, like massive pension funds and insurance companies, they actually want the illiquidity that tokenization destroys. They have multi-decade liabilities to pay out, so they intentionally seek out an illiquidity premium. So for now anyway, the very feature that makes tokenization so amazing is exactly what keeps institutional infrastructure funds away.
We've seen how tokenization creates frictionless real estate ownership and powers billion-dollar crowdsourced AI networks. The technology is proven, and it is operating at scale today. But as we look toward those legacy traditional systems still governed by decades-old contracts, it leaves us with a pretty compelling final thought. Just how long will it take for your local toll road, your massive regional power grid, or your city's water utility to eventually catch up to reality and finally become machine-readable? Thank you so much for joining me for this explainer, and keep questioning how the world around you is built.